The age of government stimulus might finally be over. China's latest massive attempt is already failing, and that's with a wave of deflation building underneath it. The more the government there announces, the more disappointment it creates. And that's already a huge concern, with one of the largest drops in industrial profits on record. What that means, however, is as Chinese industry is trying to dump its excess production on the rest of the world, they're finding it difficult, if not impossible, without drastic price cuts. This is exactly what everyone outside of China has been afraid of since dumping first propped up earlier this year. So you'd think the government over there would be urgently trying to fix the domestic part of that, to raise internal activity to counteract these deeply negative pressures. What's becoming very clear, too clear, is that there is indeed the urgency, but no real idea about what actually to do. The picture most people, certainly those in the stock market, have in mind is one where the Chinese bail out the world just in the nick of time before a major deflationary global recession, sort of like how people remember 2016 and to an extent 2009. But while Xi Jinping is throwing around huge numbers in terms of borrowing, everyone is starting to get the sense the entire point may be just to simply throw around huge numbers. This is a psychology operation rather than stimulus as most people conceive of it. China's priorities are to try to bail itself out first, and even that much is proving exceptionally difficult. So we have a lot of global markets and risk-taking that has become massively overextended based on a premise of a bazooka that is a bazooka in name only. In the meantime, the actual and cyclical global problems continue unabated. Just ask the oil market. China just confirmed a couple nights ago weak demand for oil. The stimulus package, the bazooka, is proving to be just another dud, an exceptionally pricey dud, but a failure nonetheless. And as it fails, maybe, just maybe, it proves that we're finally moving beyond the massive stimulus era. So on Friday, China's Ministry of Finance gave another press conference after the Congress voted for some legal measures related to the stimulus that had been, at least the ideas that had been announced previously. And in that press conference, many people, markets, participants, everyone was hoping for even more critical details about what the Chinese are actually planning here. And as has become usual, Chinese officials come up short on details, and what's becoming even clearer, short on ideas. What was announced on Friday was a 10 trillion yuan program for local government financing, mostly these hidden vehicles called local government financing vehicles. Basically, the central government is going to do a debt swap with these local government financing vehicles, issuing bonds through the central government into the treasury market. And it's likely to be funded through 2028. So you're talking about a couple trillion per year. That's in yuan. Total 10 trillion yuan is around $1.4 trillion in equivalency. Now, the local government said they had borrowed a ton of money to fuel these real estate bubbles, trying to get China through the silent depression, because that's what the real estate bubble was initially. Sparked in 2008 and 2009, late 2008, China was the first one to go into massive stimulus, kicking off this era of massive government stimulus. It was China who started the real estate bubble, using these local government financing vehicles in that initial wave to get it all started. And then it was real estate bubble hoping to bide time while the global economy recovered from the Great Not Recession. But because it was not a recession, because it was actually a silent depression, the Chinese continued to build upon real estate projects, building things that nobody needed in China, just to continue to keep up the idea of economic growth in lieu of going back to the way the economy worked, the global economy had worked previously, because there was no way to go back in the Eurodollar era. So it left them with all the debt, a massive price bubble, an incalculable overhang of housing supply, and worst of all, none of the economic growth, or even worse than that, growth potential. And because of that, now we're talking so many years later, well over a decade, local governments on this side of the pandemic, they can no longer service their debts because so much of their revenues had depended upon land sales and other fees collected for development. So they borrowed all of this money to build things China didn't need, which then raised government revenues, local government revenues, so they could build and borrow even more. that they didn't need, and so on and so on. All in the vain hopes that somehow, some way, first of all, the global economy would recover and China could go back to being the factory to the rest of the world as the rest of the world started to be robust again. But that wasn't going to happen. Silent depression, Eurodollar breakdown. So then the idea was they'll continue with the real estate bubble to rebalance China's economy away from industry and investment toward hopefully more of a consumer internal demand-led model, but that didn't happen either. So they continue to build up debt, they continue to build up imbalances, they continue to build and build and build without the economic growth and potential to pay for it. That's China's big problem, and there is no easy solution to it. So on the one hand, it's understandable why the central government has made local government financing vehicles and just local government finances such a priority. But it isn't what everyone has been hoping. What they're doing is still trying to clear up a past problem rather than doing something proactive to stimulate the future. And that's where the disappointment comes in, because that past problem, people are realizing, is absolutely gigantic. So as it sucks up more and more resources just to try to pay for the past, it leaves less and less for potentially the future. Not that the stimulus would do any good anyway. And that's really what the government is saying by holding off on the direct spending plans, the Keynesianism that everybody imagines. What they're really saying is, we don't think it's going to work, so we're going to prioritize stabilizing these other areas, not just local government financing. That was what the priority was on Friday. They've also announced a program to buy up houses to try to absorb some of that overhang in supply, which is dropping the bucket there. Plus, there's got to be massive amounts of funds for the Chinese bank recapitalization plan. That's a big one as well. So direct spending and stimulus, as it's commonly understood, is way down the list here, which is what markets are starting to get antsy and disappointed by, as well as realizing that all of this stimulus, all of the stuff that is being announced, again, it's looking backward, not looking forward. So to recap Friday's meeting from the Ministry of Finance, while policymakers didn't announce measures to directly stimulate domestic demand, Finance Minister Lan Foan promised, quote, more forceful fiscal policy next year, signaling bolder steps could come after Trump's inauguration in January. Yeah, it's always next year with this stuff, right? It's we're going to do something to fix the economic problem. Then, oh, wait, we'll do it in a couple months. And then a couple months later, we're going to fix the economic problem. Oh, no, we'll do it again in a couple months. We'll just wait till next year. They keep pushing it further and further off. And again, the reason why is because they're not really sure what to do. Investors had waited for weeks for the fiscal side of that campaign, with media reports stoking expectations, which is the true point here, for more spending to stabilize the property market and boost consumption. Disappointment was palpable at the start of the presser, with the offshore yuan weakening as much as 0.6% before paring the decline to 0.3% as the full scale of the package was known. That was just the usual market fluctuation. But that's really the point, as I keep saying. The idea is to stimulate sentiment, to throw around big numbers and get everybody's hopes up and hope that it sticks long enough that it starts the pump priming process and people start taking risk and the real economy starts creating activity, and then the Chinese government doesn't actually have to do anything. If they can get the economy to do the job for them, they don't really need to do anything other than announce these big numbers and then just go back and backfill in all of these trouble areas after it all works, at least according to plan. But while markets shrugged off the measures, Land called the package a, quote, major policy decision taking into consideration international and domestic development environments. Yeah, and the reason markets shrugged off all of the details because this was not the stimulus they were hoping for. And as I keep pointing out, I keep saying, everyone is starting to get the sense that they don't really know what else to do and that they're just hoping the markets do the work for them. Of course, that has worked to a big extent in the stock market, but not so much in the rest of the real economy or in the real marketplace where the markets touch real economic variables. So on Friday, the response in the crude oil market, WTI was down more than 3%, and it briefly dropped back into the $60 range before settling around $70, a little bit above that. And that was despite the fact that OPEC had announced earlier in the week that they were delaying restoring their supply, which they had already delayed before. So weak demand continues to be at the forefront of the global oil market, just hoping that something will happen in China because the oil market the global economy has a major China problem. And as I talked about in a video on Tuesday, lost amidst all of the election fury, the IEA had said that it's now considering diesel fuel, gas oil fuel, as likely to contract. Usage of this critical energy format is going to contract this year, which is a rare occurrence. Hadn't happened since 2020. And that's one reason why we keep seeing oil curves, diesel curves, gasoline to an extent too. But really, oil start to lose its backwardation. WTI futures flattening out and now are within sight of contango because with weak demand, not just in China, but around the rest of the world, including the United States, there is a huge and growing risk of actual oversupply of crude, which is why OPEC didn't restore their supply as they had anticipated just a couple months ago. Copper is another one, a key commodity. That one has been all over the map this week. It's down 3% on Friday, but it had been up 4% on Thursday, given stimulus rumors. That followed a 5% decline on Wednesday, which brought it all the way down to 423. And despite this huge up and down back and forth, copper's just kind of stuck around the 430 range, basically where it's been after the initial stimulus euphoria really started to wear off. And the big one, certainly to me, Chinese government bonds. Bond yields in the Chinese marketplace are not buying the stimulus whatsoever, any part of it. There was a backup in yields. For example, the Chinese 10-year bond, the rate got up to around 2.21% on October 8th. First of all, that wasn't even that much of a sell-off from where it had been at the lows in the early part of September. So it didn't back up all that much to begin with from the record low. Got up to around 2.21%, and then as of Friday, it's already back down to 2.12%, which means closer to the record low than not. And nothing that the Chinese government has done throughout October and into November has dissuaded bond buyers from buying more bonds. The 2-year Chinese government bond, that one got down to 1.35% in the middle of September, which was near a record low, just getting in very close to the low set in 2020. It went back up to 1.48% on October 9th and got a little bit higher toward the end of October, 1.58%. But then even here, since October 23rd, 2-year Treasury in China going back down to 1.44% as of Friday. So much for either the stimulus or the PBOC. The PBOC that had been trying to derail the bond rally, which dates all the way back to last December, saying that, among other things, better watch out when the Chinese government really gets going. The avalanche of bond supply is going to completely obliterate the Chinese bond market. That's the warning that they were trying to send, and really nobody bought it. Because first of all, supply doesn't matter. Fundamentals do. And the fundamentals are, for China, same as the United States, lower growth and inflation expectations, no matter what Beijing does with its bazookas. In fact, the more the Chinese do, the worse you know it is. That's what the bond market is trading on, and it ignored the PBOC because the fundamentals are the ones that demand the Chinese government do bigger and bigger things. In terms of economic data, though, the Chinese government announced just recently that industrial profits had absolutely collapsed during the summertime. What they announced on an accumulated basis for industrial profits was it had seemed pretty steady through the middle part of the year. The accumulated year-to-date rate, the year-over-year change in the accumulated year-to-date for industrial profits was 3.4% in May, 3.5% in June, and 3.6% in July. So relatively steady through the middle of the year. Then suddenly the accumulated rate fell to just plus 0.55% in August. But then September, it took an even worse turn down to minus 3.5%. And on an accumulated basis, a year-to-date basis, it would take an enormous decline that far into a year to turn around an accumulated year-over-year change. And that's exactly what they announced. In August, minus 17.8%, just in the month of August. And as bad as that was, which was among the worst in the entire series, September comes in at minus 27.1%, which is actually the fourth worst in the entire history of Chinese industrial profits. The only times that have been worse were January and February of 2020. That's a single period. March of 2020, and then the January-February period in 2009. So what that said was that as the Chinese government is telling industrial firms and manufacturers to dump their excess products on the rest of the world, the Chinese have been doing it, as we'll see in just a second, with their export numbers, but they've been finding it increasingly difficult to the point that they have to drastically reduce prices just to sell what they've made on global markets during the summer. So not only is this a negative reflection on China's position, but it also tells you about global demand falling off sharply during the summertime. Another one showing exactly the same cyclical change. The export number looked really good. It was up 12.7% in US dollar terms year over year, October 2024 compared to October 2023, well above expectations for around 5%. And that was far better than September's, which had been a 2.4% year over year. And they sold a lot of the stuff that people have been complaining about: integrated circuits, appliances, and a ton of cars that were shipped from China all around the world, as we just saw in industrial profits, but only after uncorking a huge wave of deflation in goods. It's everything that everyone around the world has been afraid of as far as Chinese dumping their excess. Not only do we have them undercutting local production and local capacities around the rest of the world, but that also negatively reflects upon conditions around the rest of the world. Massive price discounts just to sell their goods, not to gain market share, just to get rid of the stuff. And Chinese imports, just by the way, those actually declined 2.3% year over year in October. There was another weak month for crude oil demand, meaning Chinese imports of crude oil volumes were down 8% compared to October 2023. So that's why OPEC isn't going to restart their production. That's why oil prices continue to be weaker no matter what happens in the Middle East, because the oil market has an enormous China problem. And none of the things that Beijing have announced thus far are going to do much about it. That's what the market position is, and not just in oil and energy, copper, as well as bonds and everything else outside of stocks. So China's stimulus is disappointing because they're stuck trying to bail out all of their past mistakes, not really giving themselves a whole lot of room. They keep saying they have a ton of room, but they're really not giving themselves a whole lot of room to do something about restarting into the future. But maybe most important of all, they don't really know what to do here. And I think that's the message that the markets are starting to really hone in on. The real economy is in big trouble regardless of what Beijing does. And people are starting to see this isn't just going to be some easy fix just by throwing a few trillions or tens of trillions around. Real estate, local governments, bank recapitalization, maybe they'll get around to some direct spending at some point. But it won't matter. This isn't 2016 or even 2009. The age of stimulus is over. Maybe the most important news this week, aside from the US presidential contest, the IEA, gas oil, diesel demand, outright contracting. I went over those details in the video link below. As always, thank you very much for joining me. Huge thank you to Eurodollar University members and subscribers. Until next time, do take care.